from Creativo Solutions. You're currently watching the Finance for Non-Financial Managers video series. If you do have any comments or questions about anything in the video, please post those below and subscribe to this channel to be the first to find out when new videos are uploaded. Visit the website for more content and resources. We are also on Instagram and Twitter, so please consider following us and keep watching the YouTube channel for more support. We've just discussed the relationship between finance and economics in the previous video. We spoke about concepts like inflation, debt, bankruptcy, and other that will affect decision making in that actual business. We know financial managers need to focus on maximizing value, and their decisions are going to be affected by different economic developments within the economy, and the market determines how well the company is going to perform. Having information is key because that will allow the business to make better decisions, and if the business understands economics, they'll be able to make decisions in light of what's happening in the market currently. We are now going to be discussing finance and accounting and how these two relate. So we've established that finance is going to be focusing on the limited resources that the business has, and they're going to be allocating those resources to different areas. So they might be allocating part of the budget to marketing and advertising, or maybe they're going to be allocating some of the budget to IT and maybe upgrading the computer systems. So when looking at finance, we know the financial management is going to be concerned with the limited resources that they need to allocate appropriately to different areas. And in doing so, they're going to have to try uncover what output or what outcomes have been achieved having allocated those resources. So finance is going to be the resources, and that's going to be something that we need to account for. So the accounting is the language of conveying that information to users. So financial managers would be users, and they'd be using the information to help them make decisions. The only way we can actually understand if the decision was correct or not is by having that actual information. So the accountants generate that information from all the transactions that arise when dealing with the actual decision making around managing finance. Because if we're going to be managing finance, there are going to be certain decisions that will give rise to certain transactions, and those transactions will be recorded in the accounting department. So the accounting department is responsible for providing that information. It's important because without information we cannot make decisions. Having this information allows us to make much better decisions, and that's always the focus. We're trying to make the best possible decisions with the information we have to try to generate the most return. So if we're focusing on finance and accounting, we know accountants are going to be using very specific rules, and those rules come from the International Financial Reporting Standards. When focusing on the data and information, we know that needs to be presented according to specific layout and format, which is disclosure around the financial statements. When looking at the accounting cycle, we know the financial statements would be the end product that users will be using in order to make decisions. Auditors would be there to verify that the information contained in the financial statements are reliable and accurate. So what is its purpose? Well, it's always going to be focused on decision making. As a business, the financial manager needs to determine which plans or which projects or which investments are going to generate the most value, and the only way we can do that is by having information and then establishing which option would be the best. When covering finance and when managing the financial management of the business, we need to obviously have skills in accounting. The accounting skills are going to allow us to interpret and understand information. So when looking at financial performance, this is something we've covered in the Accounting for Non-Accountants video series, and we've established that financial performance is obviously the difference between our income and our expenses. that determines how well we're performing as a business. Without this information, the financial manager will not be able to make good decisions. Having skills in accounting can definitely help the financial manager, and most financial managers generally have some sort of accounting background. When looking at concepts like the financial position, here we're looking at the difference between our assets and our liabilities to determine if the business is in a good or bad position. We've established what finance is all about. We know it's limited resources that need to be allocated to maximize return. We've now discussed accounting in a short summary whereby we're focusing on the actual information that's being created. And that information comes from the transactions that the actual business is going to be entering into. The focus is always going to be on quality information. In order to make good decisions, we need information, and that information is going to be derived from the data that we will be collecting. The process data will provide us with quality information, and the better the information, the better the decision making. When looking at finance and accounting, there are certain things that we can calculate to help us with the decision making, and that would be considered ratios or ratio analysis. When looking at the quality information that we've derived from the financial statements, we can take that information one step further. We can process it even more by analyzing that information and generating certain measures that can help us with decision making. So ratios like the current ratio, the quick ratio, or ratios around solvency can assist us with making certain decisions. We can also look at other areas such as profitability, maybe leverage, or the return on equity or return on assets. So there are many different ratios that we can make use of whereby we're taking the information and we're analyzing it further. We've processed the data and we've got something that we can use in order to help us with the decision making. The better the information, the easier it is to make a good decision. And if we can analyze the information further, that can uncover even more about the business, because we're uncovering specific measures that can provide us with very specific information or insight into that particular business. We can look at its debt, we can look at its equity, we can look at a whole host of different areas in the business, and that'll tell us more about the operations and how well the business is performing. Decision making entails some sort of problem solving whereby you're going to be analyzing information in order to get an option that you're happy with, and that's something that you'll implement. So the decision making involves analysis because we need to motivate why we're going with a particular option or plan. So if we're choosing plan C over plan A and B, why are we choosing that option? We need to motivate that choice with different measures or different facts that we've uncovered from the data that we've got that has been processed, and that creates the information. If we can motivate the why, that supports the decision making. We cannot just say, well, we're going to be choosing this option because we like this option. That's one way of making a decision, but that's not going to be the best way to make decisions, because decisions that we're making based on our emotion, I like this project or I don't like this project, isn't going to generate the most return, because we need to keep objective and we need to look at the facts. So the facts are going to be part of the analysis process that we're going to have to go through in order to uncover different measures, such as these ratios here, that would help us with the actual decision making. Having information is one thing. Knowing how to analyze, interpret, and use the information is even more important, and that's what the financial manager is going to focus on. It's taking the information which the accountants have generated in the form of financial statements and utilizing that information to the best of their ability in order to make the best decisions possible for the business that'll help grow the business in terms of value. And that concludes this video. Thank you for watching, and please consider subscribing to this channel. If you have any comments or questions, please post them below, and hit the thumbs up button if you like the video, and we'll keep making more to help you.